Derivatives trading involves substantial risk of loss and is not suitable for all investors. Past performance is not necessarily indicative of future results.
So stressful. World's on fire. Good God. I can't look at this, guys. Like, my strategy is you buy it and you hope that you get a spot. Yeah, but we all think you're crazy. You don't fight this. No way. But the markets are freaking out and you don't think that anything is wrong? Come back tomorrow and I'll lose it all. Should be fun.
Good morning, everybody. Well, I have a baby with me here somehow. Somehow I got left with the child and my wife took somebody else to go to a doctor's appointment. So, but I think that this, if there's anything in here, this is going to like move like wild. But I'm not expecting too much off of the announcement itself. I think that the press conference is going to be a much bigger deal, as is often the case. So I was trying to change this over here. I want okay. Just to make it easier on me to be able to tell that my DOMs are safe. Because this is not the kind of action where you'd want to like accidentally click on something, right? Well, the DOM is completely thinned out. Okay. So we're good on that front. So a 70.5, yes, 75 basis point hike is the expectation. You lose your binky. You want it back? Don't gouge your eyes out. That wouldn't be very comfortable. No, I want to, mess with my hand. You gonna pick your nose? Okay. It's going to be really interesting this time, to see how the statement changes on the economic, because they always make comments on the current economic situation, right? So that's what we're going to be looking at for here, because it's almost positive that it's going to be 75 basis points. I mean, if it ends up being, I'll arm this. Okay, if it ends up being 100 basis point hike, it doesn't matter what price it is, just buy the 10-year, right? Should we get to the binky? Where's the binky? Here's the binky. Oh, you want that binky? You don't want the binky. There you go. See? You don't need to freak out. You need to have the binky. Feeling sleepy? You're gonna if you fall asleep now, you've got a whole 20 seconds, or you'll miss the excitement, bud. Here we go. Oh, there's no like I can't believe that there are people with actual orders sitting out there right now. If you have an order on the 10-year, okay, 75 basis points. My news squawk guy said that like way too dramatically. Hike 75. Well, of course it's a hike. I was here listening for 7. Was unanimous. So I'm waiting for the statement comparison here on Twitter. That's always something that I really like to see. Here we go. Okay. Open image in new tab. I will bring it up here for you guys and make it really nice and big. Okay, so the statement overall economic activity appears to have picked up after edging down in the fourth quarter, has been replaced with recent indications of spending and production have softened. Nonetheless, job gains have been robust in recent months. They added higher food and energy prices in there. Russia's war against Ukraine is causing tremendous human and economic hardship. And then that was it. Whoa. That was it. Wow, that was. I don't think I've ever seen. So they made a note about. I mean, they did change their comment on the economy. I'm not sure that I would say that it's different, but they are saying that spending and production is softened, but employment gains are still good. So, and then they added, a point about Ukraine that was just kind of like, a nod to that it's a terrible thing, but nothing about the economy. So that was really the most uneventful rate hike decision comment I've ever seen. Does me talking make you sleepy, Ethan? Huh? So we got 30 minutes to chill here. But like, here's the thing. It's not the statement that we should be worried about. It was 70. I mean, there was a small chance that it would be 100 basis point hike, but nope, it was 75 basis point hike. It's going to be the meeting. It's going to be the press conference. That's if it really hits the market, because they're going to ask him about the economy, and he's going to be like, well, it looks like the economy is pretty good, and I think that we need to continue increasing rates. Or, I don't know, we're still concerned about inflation, and we're going to do whatever it takes. I don't know, like, 2.7 just seems low to me, that's all. 2.7 just seems low to me, that's all. This boy is out cold. Okay, so I am seeing the 6J and gold moving up along with maybe the treasuries slightly. What are the expectations for the next hikes? This is a good question. Because they were at 75, but I haven't looked at it today. And we'll see if it's changed at all today. So we did get like a little bit of a pop from like volatility's sake, but generally speaking, it hasn't really gone anywhere. I'm surprised at the number of lots that are sitting out there. Like, okay. Have fun with that one. Okay, so September. Oh, okay. So we're at 2.25. They are 50%. 50% are saying 50 basis point hike. Well, 48.8 and 43.1 are saying 75 basis point hike. So the market is evenly split on what the next hike will be in September. And then if I come in here to compare, it looks like the chances of it being a 50 basis point hike have declined over the past week or so, or month, really. What about when we come over into November? See, this is where it's like it doesn't make sense to me. Is like all of the expectations are that it will be above 3%. How can the 10-year be below 3% right now then? Right. If they all expect that it's going to be higher than that. There's a very clear mispricing in here. Hey. Well, they're kind of selling off a little bit now. I'm kind of tempted to just hit in here and just sell it, but I mean, my thinking at the moment, we could do a sim. Because my thinking right now is that if the Federal Reserve is about to do a dovish pivot, that was not it, right? Like, well, they're holding down here pretty well, especially in the 5-year. There's a really big old lot there at 31.5. For just for fun, I'm going short here on the Treasury. I don't think that I see anything here that could really strongly justify me taking a trade on my live account off of this. But I do kind of have the inkling that, again, if the Federal Reserve was going to be making like a dovish pivot here, I that's not the statement they would have put out. I am expecting that he will be more hawkish than expected in the press conference, and that he's not going to be saying, the economy is looking really bad and we need to ease things up. I just don't think he's going to say that, even though that's what the market seems to be thinking is going to happen. So, longer term, I feel that there should be a larger repricing on the yield curve. So that's kind of why I'm just taking the YOLO short here. Boom. Thank you. that flow right there kind of making me think that I should be taking it live. Well, I think the problem that we have here with any kind of a trade is that, well, I might be able to make, you know, a little bit before their press conference. You know, things are going to get a little more difficult in the press conference. So I don't know if it's really worth it to take a bet here. And that move down, it was, yeah. It was really forceful. And so that was like, that really makes me want to go short. But I didn't go short because I know that the liquidity is so low that that could have just been somebody sneezing. Hmm. Come on. Good. So just note buyer's cost basis on the day is like right there at 120 or so, maybe a little bit above 120. So, okay, News Squawk, Snap Analysis. FOMC lifted rates by 75 basis points to 2.25, 2.5, as was expected. By the way, always remember when they give those ranges, just assume the bottom end of the range because the federal funds rate tends to sit at the bottom end of the range and then goes to the top if there's like, strong demand. So really it's at the lower end most of the time, and that's the number that everybody thinks about, okay? Taking rates back to neutral for the first time since 2019. The only major tweak to the statement was its reassessment of the economy. The Fed now acknowledges that recent indicators of spending and production have softened. Recall it previously said that overall economic activity appears to have picked up after edging down in the first quarter. This change was to be expected given the softening in key macro indicators. Going into the rate decision, a very small minority of analysts were suggesting that the Fed could slow the pace of its balance sheet normalization, but the central bank opted against doing so. The statement offers no clues about what the Fed will do at its September meeting. Traders will be looking to Chairman Powell's remarks for a guide here. Money market pricing still expects the Fed will lift rates to 3.25 to 3.5 by the end of the year. So again, how can the money market, how can the short-term rates be saying we're going to get to 3.25 if the 10-year is at 2.7? It makes no sense. It really doesn't. Okay, well, I think I'm trying to build myself as much room as I can here. Okay. My news squawk is saying that the yield curve is steepened, but when I look at it, it doesn't look like it's really changed all that much. That child, he keeps saying, "Oh no, oh no." Maybe that's not what he's saying, and maybe he doesn't know what he means, but that's all he says nowadays is, "Oh no, oh no, oh no." The last 3 meetings, well, they were much more volatile off of the initial statement, that's for sure. I don't think that there was any way that this meeting was going to be as big off of the actual rate announcement as last time, well, unless it was going to be a 100 basis point hike, right? Yeah, 50 to 80 points before Powell. The S&P 500 has really not reacted, isn't it? But like that's the thing is that the that statement, they barely changed it. They barely changed it. I'm kind of wondering what's going on there because I feel like so much has happened since the last interest rate hike. Like, I feel like the statement should be significantly different. I don't, you know? But I I mean, and I could be wrong, of course, but I think that there's still some really good potential for the market to move off of something that Powell says. They're going to find something. They're going to latch onto something that Powell says, right, and move on that. So we'll see what it ends up being. Yeah, this was only 20 points. And the S&P 500 was just really quiet the whole morning anyways, right? But see, even here in the 10-year, now I'm fighting for ticks, huh? Okay, cool. Well, Phil is fine. Hmm. See, if I was in a live trade right now at 770, let's say 2.77, I think I'd be pretty annoyed. Hmm. Holding this baby is getting my arm is starting to get tired. Got him in a good spot though. I could try putting him back in the cradle in his swing. So where should we put Powley? Powley. Good grief. What's wrong with you, Seth? Talking like that. Thanks, NASDAQ Killer, for the comment. Yeah, if you guys haven't seen my video on micro treasury futures, you should go watch that and give it a comment. Hmm. So I could keep it there, or I could move it up where the S&P 500 is. And keep it. Keep it like that. Hmm. Hmm. Aha. Well, if I really wanted to take one now, I think that the prices I'm getting aren't too bad, right? FX Street News tweets gold rallies on slight dovish tilt at the Fed. All eyes on Powell. I mean, it kind of rallied like $5. I mean, I I don't know if we should make too big of a deal. I don't understand why financial institutions are willing to tweet about things like that. Like, well, you know what? Ahead of this meeting, since he's out so cold, I am going to go and put him in his rocker, okay? Oh, my arm is like numb. Okay. What do we got? No fill at 20, huh? Hmm. And when I'm watching Twitter, it's just all everybody. Oh, yep, there was an interest rate decision today. Well, I don't know if I should add it 0.3 That's probably a little dangerous. The street. The street just tweeted vibing to the FOMC press conference waiting room music like, and then it has a picture of the guy from The Office dancing. Okay, here we go. Gonna unmute that. I have to say the deltas in the treasuries since we really this early this morning have all been all down. So I'm kind of wondering here. Okay, here he goes.
Good afternoon.
And get this good and loud for you.
My colleagues and I are strongly committed to bringing inflation back down, and we're moving expeditiously to do so. We have both the tools we need and the resolve it will take.
Did the audio just cut? Oh, no, that's me.
The economy and the country have been through a lot over the past 2.5 years and have proved resilient. It is essential that we bring inflation down to our 2% goal if we are to have a sustained period of strong labor market conditions that benefit all.
I'm gonna leave it alone.
From the standpoint of our congressional mandate to promote maximum employment and price stability, the current picture is plain to see. The labor market is extremely tight, and inflation is much too high. Against this backdrop, today the FOMC raised its policy interest rate by 0.75 of a percentage point.
Like, this does not sound dovish at all.
Increases in the target range for the federal funds rate will be appropriate. In addition, we are continuing the process of significantly reducing the size of our balance sheet. And I'll have more to say about today's monetary policy actions after briefly reviewing economic developments. Recent indicators of spending and production have softened. Growth in consumer spending has slowed significantly, in part reflecting
Look at that.
real disposable income.
I was thinking about doing it and
activity in the
I didn't leap.
higher mortgage rates.
I'm too
And after a
scared.
strong increase in the first
I
quarter.
don't think I'm in the mental space to do this today, guys. I'm just gonna turn it off because I want to buy it so bad.
Despite these developments, the labor market has remained extremely tight, with the unemployment rate near a 50-year low, job vacancies near historical highs, and wage growth elevated. Over the past 3 months, employment rose by an average of 375,000 jobs per month.
Sim trade worked out well though, didn't it?
Earlier in the
Now I can just kind of chill.
Improvements in labor market conditions have been widespread, including for workers at the lower end of the wage distribution, as well as for African Americans and Hispanics. Labor demand is very strong, while labor supply remains subdued, with the labor force participation rate little changed since January. Overall,
Does the flag have a stain on it? It does kind of look like it. Maybe it does, doesn't it?
solid. Inflation remains well above our longer run goal of 2%.
Can you make it super big and see if I can see the stain a little bit better?
Total PCE prices rose 6.3%, excluding the volatile food and energy.
Yeah, I think you're right.
Core PCE prices
How do you manage your stuff?
7%. In June, the 12-month change in the Consumer Price Index
Hold on.
above expectations at 9.1%, and the change in the core CPI was 5.9%. Notwithstanding the recent slowdown in overall economic activity, aggregate demand appears to remain strong. Supply constraints have been larger and longer lasting than anticipated, and price pressures are evident across a broad range of goods and services. Although prices for some commodities have turned down recently, the earlier surge in prices of oil and other
So the way that you manage your stop in moments like this is don't have a trade on.
creating additional upward pressure on inflation. The Fed's monetary
This is why I'm too afraid to take a trade over here, because it's like, okay, I could have made $10, but
American people. My
you don't know which way it's going to go. You know, he really could just at any moment say something super dovish or super hawkish and the market just completely jump, right? So
we are highly attentive to the risk
it's probably better
sides of our mandate
with the size of the account that I'm working with right now
to our 2%.
to not mess with that. That's why I come in and do it on Sim
At today's
to
meeting,
give myself a bit of, you know,
target range for
market make in this area, give myself a bunch of room to let it run.
the target
Now I got it to run a little bit. I can just let it ride. And if it comes against me and goes to new highs today,
balance sheet, which plays an
Fine.
important role in firming the
take my profits,
monetary policy.
right?
Over coming months, we will be looking for compelling evidence that inflation is moving down, consistent with inflation returning to 2%. We anticipate that ongoing increases in the target range for the federal funds rate will be appropriate. The pace of those increases will continue to depend on the incoming data and evolving outlook for the economy.
Oh dear.
Today's increase is in the target range is the second 75 basis point increase in as many meetings. While another unusually large increase could be appropriate at our next meeting, that is a decision that will depend on the data we get between now and then. We will continue to make our decisions meeting by meeting and communicate our thinking as clearly as possible. As the stance of monetary policy tightens further, it likely will become appropriate to slow the pace of increases while we assess how our cumulative policy adjustments are affecting.
Okay, so that's a flat.
inflation.
I'm going to go flat there.
Our overarching focus is using our tools to bring demand into better balance with supply in order to bring inflation back down to our 2% goal and to keep longer-term inflation expectations well anchored. Making appropriate monetary policy in this uncertain environment requires a recognition that the economy often evolves in unexpected ways.
My feed
Inflation has
just
obviously
reset.
surprised to the upside over the past year, and further surprises could be in store. We therefore will need to be nimble in responding to incoming data and the evolving outlook.
It was just the sound of
Uncertainty
my
already an extraordinarily challenging,
jigsaw reconnecting to the data feed because it
highly attentive to
went
inflation
out for a moment.
and determined to take the measures necessary to return inflation to our 2% longer run goal.
Do I have something in Rhythmic that can help me see that sort of
Likely to
thing?
involve a period of below-trend economic growth and some softening in labor market conditions. But such outcomes are likely necessary to restore price stability and to set the stage for achieving maximum employment and stable prices over the longer run. To conclude, we understand that our actions affect communities, families, and businesses across the country. Everything we do is in service to our public mission. We at the Fed will do everything we can to achieve our maximum employment and price stability goals. Thank you. I look forward to your questions.
Okay. So when he said anything about what the next meeting was going to be, the market really moved, but it moved down and then right back up. So
Wondering if you can walk us through your thinking around the decision not to go for a full percentage point increase. We saw a ramp up after the May CPI report came in hotter than usual, and then obviously the June.
this is a mess.
Was there any discussion of a stronger hike at this meeting?
So they're kind of edging down just because she's asking the question.
75 basis point increase was the right magnitude in light of the data and in the context of the ongoing increases in the policy rate that we've been making. I'd say that we wouldn't hesitate to make an even larger move than we did today if the committee were to conclude that were appropriate. That was not the case at this meeting. There was very broad support for the move that we made. You mentioned the June meeting. We had said many times that we were prepared to move more aggressively if inflation continued to disappoint. And that's why we did move to a more aggressive pace at the June meeting, as we said we would do. At this meeting, we continued at that more aggressive pace as inflation has continued to disappoint in the form of the June CPI reading.
Thank you so much for taking our questions. Colby Smith with the Financial Times. As the committee considers the policy path forward, how will it weigh the expected decline in headline inflation, which might come as a result of the drop in commodity prices, against the fact that we are likely to see some persistence in core readings in particular? And given that potential tension and signs of any kind of activity weakening here, how has the committee's thinking changed on how far into restrictive territory rates might need to go?
So I guess I'd start by saying we've been saying we would move expeditiously to get to the range of neutral, and I think we've done that now. We're at 225 to 2.5, and that's right in the range of what we think is neutral. So the question is, how are we thinking about the path forward? So one thing that hasn't changed is that it won't change is that our focus is going to continue to be on using our tools to bring demand back into better balance with supply in order to bring inflation back down. That'll continue to be our overarching focus. We also said that we expect ongoing rate hikes will be appropriate and that we'll make decisions meeting by meeting. So what are we going to be looking at? We'll be looking at the incoming data, as I mentioned, and that'll
The incoming data.
We're seeing the slowdown the slowdown in economic activity.
This whole time I thought that they were looking at chicken bones.
And there's some evidence that we are at this time. Of course, we'll be looking at labor market conditions, and we'll be asking whether we see the alignment between supply and demand getting better, getting closer. Of course, we'll be looking closely at inflation. You mentioned headline and core. Our mandate is for headline. Of course, it's not for core, but we look at core because core is actually a better indicator of headline and of all inflation going forward. So we'll be looking at both, and we'll be looking at them at those both really for what they're saying about the outlook rather than just simply for what they say.
S&P is taking off here.
Inflationary pressures declining. Do we see actual readings of inflation coming down. So in light of all that data, the question we'll be asking is whether the stance of policy we have is sufficiently restrictive to bring inflation back down to our 2% target. And it's also
Yeah.
worth noting that these
You just ride that one for whatever it's worth, man. That's a lucky call.
likely that their full effect has not been felt by the economy. So there's probably some additional tightening, significant additional tightening in the pipeline. So where are we going with this? I think the committee broadly feels that we need to get policy to at least to a moderately restrictive level. And maybe the best data point for that would be what we wrote down in our SEP at the June meeting. So I think the median for the end of this year, the median would have been between 3.25 and 3.5. And
I
then
need to switch my workspace
50
here, I
basis
think.
points higher than that for 2023. So that's, even though that's now 6 weeks old, I guess, that's the most recent reading. Of course, we'll update that reading at the September meeting in 8 weeks. So that's how we're thinking about it. As I mentioned, as it relates to September, I said that another unusually large increase could be appropriate, but that's not a decision we're making now. It's one that we'll make based on the data we see, and we're going to be making decisions meeting by meeting. We think it's time to.
Yeah. Well, I think that Oliver, that he took
your guidance that we had provided on the
he did take a little bit of profits, right? So Kevin took some profits, and now he can put a stop at break even plus one. So no matter what, he's going to make money, right?
Through influencing expectations.
It's just kind of like right now he's like making $50, $100 per micro contract.
Conditions to stay tight. Futures market pricing currently implies you will raise rates this year along the lines of your June SEP, but then lower them a few months later next year. Are these expectations consistent with the need to keep financial conditions tight in order to moderate purchasing power and bring inflation back to 2%?
So I'm going to start by pointing out that
This could be where
hard to say with any confidence in normal times what the economy is going to be doing in 6 or 12 months. And so to try to predict what the appropriate monetary policy response would be, I mean, of course, we do that in the SEP, but nonetheless, you've got to take any estimates of what rates will be next year with a grain of salt, because there's so much uncertainty. These are not normal times. There's significantly more uncertainty now about the path ahead than I think there ordinarily is, and ordinarily it's quite high. So again, the only data point I have for you really is the June SEP, which I think is just the most recent thing that the committee's done. Since then, inflation has come in higher, economic activity has come in weaker.
going to trade it down.
But at the same time, I would say that's probably the best estimate of where the committee's thinking is still, which is that we would get to a moderately restrictive level by the end of this year, by which I mean somewhere between 3 and 3.5%, and that the committee sees further rate increases in 2023. As I mentioned, we'll update that, of course, at the September meeting, but that's really the best I can do on that.
You said inflation had been a little bit hotter.
Sorry, you didn't answer the question.
View of the terminal rate changed since June.
So I wouldn't say it was. I think we didn't expect a good reading, but this one was even worse than expected, I would say. I don't talk about my own personal estimate of what the terminal rate would be. I will write down that it's going to evolve. It's obviously it has evolved over the course. I think for all participants, it has evolved over the course of the year as we learn how persistent inflation is going to be. And by the time of the September meeting, we will have seen 2 more CPI readings and 2 more labor market readings, and significant amount of readings about economic activity and perhaps geopolitical developments. Who knows? It'll be a long. It's an 8-week intermeeting period, so I think we'll see quite a lot of data, and we'll make our decision at that meeting based on that data.
Gina. Hi, Jarrell. Thanks for taking our question. Gina Smilik, New York Times. You kind of alluded to this earlier, but I wonder, in the event that you see several months of very weak headline inflation numbers because oil prices are coming down so much, but core inflation continues to be strong or even picks up, I wonder how you would think about that.
There was this big iceberg there at 11.5.
So it's hard to deal with hypotheticals, but
it's easier to size up your clip than to force movement over the market. Well, but the thing is that you size your clip, and then all of a sudden there's a big move it takes against you, and yeah, you can have a stop, but there's no guarantee that you're going to get the price that your stop is at, right?
Will be set at
And so, what kind of ends up happening with that one? You know, like I used to do that a lot in ES, and then one time I took a 10-point
depend on a lot of
slippage. So.
Core inflation is a better predictor of inflation going forward. Headline inflation tends to be volatile. So in ordinary times, you look through.
See, what I'm doing here with what you can see on the screen
The problem
is I'm taking on excessive risk. Like what I'm doing is really quite
those can actually start to undermine
inadvisable.
Or to
Wouldn't recommend it.
work on de-anchoring
Yeah.
inflation expectations. The public doesn't distinguish between core and headline inflation in their thinking. So it's something we have to take into consideration in our policymaking, even though our tools don't really work on some aspects of this, which are the supply side issues.
Steve Leisman, CNBC. Thanks for taking my question, Mr. Chairman. Earlier this week, the president said we are not going to be in a recession. So I have two questions off of that. Do you share the president's confidence in not being in a recession? And second, how would or would not a recession change policy? Is it a bright line, sir, where contraction of the economy would be a turning point in policy, or is there some amount of contraction of the economy the committee would be willing to abide in its effort to reduce inflation?
So as I mentioned, we think it's necessary to have growth slow down, and growth is going to be slowing down this year for a couple of reasons. One of which is that you're coming off.
So anyways, the thing is if you come in and you take a bunch of little small trades in here, right? You can kind of you can build up enough room to you know, if it does come up against you, you don't actually lose anything because you've right. You're
We also think
I want the blue to be way up here. It's not working right now.
and those are
So what I'm going to do is I'm going to keep doubling down on this
necessary if we were
to show you how bad it can be. Okay? Well, see, because right now I'm the wrong way, right? So see how bad it can get. Because like the thing was when I kind of averaged in and was doing this and I got a little bit of a winner on the downside, I made like 500, right? If this keeps going, I could lose like 3,000, right?
Price stability is really the bedrock of the economy, and nothing works in the economy without price stability. We can't have a strong labor market without price stability for an extended period of time. We all want to get back to
Your idea was simple. I don't know. I find
the pandemic.
I'm actually really surprised that was your reasoning, Kevin, because
Gender differences and that kind of thing.
you came in and posted about it like just as the ES was taking off, and it kind of felt to me like it was reacting to something that he said, but I didn't really see anything that really justified a move like that, you know?
Something we see as something that we simply must do, and we think that we don't see it as a trade-off with the employment mandate. We see it as a way to facilitate the sustained achievement of the employment mandate in the longer term.
Howard Schneider with Reuters. Particularly in regard to expectations, it's been said the last few months that the risks of doing too little outweighed the risks of doing too much. Does that remain the bias?
So we're trying to do just the right amount, right?
What is wrong with my watermark?
Recession, and we don't think we have to. We think that there's a path for us to be able to bring inflation down while sustaining a strong labor market. As I mentioned, along with, in all likelihood, some softening in labor market conditions. So that's what we're trying to achieve, and we continue to think that there's a path to that. We know that the path has clearly narrowed, really based on events that are outside of our control, and it may narrow further. So, you know, I do think,
Well,
as I said just now, that
tried to make it a teaching moment, and
there isn't
it's working out too well for me.
because that is the thing that enables you to have a strong labor market over time. Without restoring price stability, you won't be able to, over the medium and longer term, to actually have a sustained period of very strong labor market conditions. So, of course, we serve both sides of the dual mandate, but we actually see them as well aligned on this.
But as a follow-on to that, given the uncertainty and the sort of paradoxical flow of data you've been getting, if you're going to make a mistake, would you rather make the mistake on doing too much, raising too much, than raising too little?
Yeah, we're trying not to make a mistake. Let me put it this way. We do see that there are two-sided risks. There would be the risk of doing too much and imposing more of a downturn on the economy than was necessary. But the risk of doing too little and leaving the economy with this entrenched inflation, it only raises the cost. If you fail to deal with it in the near term, it only raises the cost of dealing with it later. To the extent people start to see it as just part of their economic lives, they start to factor high inflation into their decisions. When that, on a sustained basis, when that starts to really happen, and we don't think that's happened yet, but when that starts to happen, it just gets that much harder, and the pain will be that much greater. So I really do think that it's important that we address this now and get it done.
See, like the thing, Oliver, that I was trying to show is that it's a fat-tailed strategy. Like, you will get away with it most of the time. That's why I enjoy doing it on Sim, right? Because it gives me something to click, and it always feels good because usually it works out for you. And then when it doesn't work out, you just go flat, and oh well, it was Sim. You know what I mean? But it worked out. It's going to work out like 80% of the time. It's probably going to work out unless you're getting a really strongly trending market one way, right?
In particular, as I mentioned,
there was a possibility that was just going to keep trending on us, right? But they got up to where the resistance has been in the past week or so, and those sellers came back in. So
growth, I think payroll jobs averaging 450,000 per month. That's a remarkably strong level.
When I'm looking at this, I feel like that there's a little bit too much technicals involved here.
The wage measures that we track are running.
Don't feel like that the market is really moving on fundamentals,
2.7 million people hired in the first half of the year. It doesn't make sense that the economy would be in recession with this kind of thing happening. So I don't think the U.S. economy is in recession right now. Haven't seen it, and we'll just have to see what it says. I don't. I would say generally the GDP numbers do have a tendency to be revised significantly. It's just very hard. It's very hard to accumulate U.S. GDP. It's a large economy, and a lot of work and judgment goes into that. But
so, in case you didn't hear the question that they asked him here, they asked if he had seen GDP, because GDP gets released tomorrow morning, right? So if GDP tomorrow morning is negative, then that would technically put us in a recession. But you have to remember that that's a preliminary number, and they release a revised number several weeks later, and that revised number can be significantly different, is what he was saying. So he's kind of saying that, like, the call, like 2 negative quarters, we're in a recession. We can't really actually say that tomorrow for sure. But I'm surprised, because I think that one is kind of an important data point. I'm surprised that they haven't seen that one.
Building the infrastructure,
but I guess he gets it with the rest of us. Somebody in the government's got the number, could have given it to him.
Cleared, and the amount of trades you make will be they'll have to be 45 days or more before any FOMC meeting. It's just, I think we've really created a very strong and robust set of rules that will support public trust in the institution. And again, we're just now.
Why are they so afraid to say it?
Proud of what we did.
Well, because if you come in, listen, if Jerome Powell said, "I believe we are falling into a recession right now," you have any idea how the market would react to that, right? Like, they would totally flip out. So he can't say that, right?
For making the decision on how much to raise rates, and
the whole thing. Please no, that would screw my lung, right? Kevin's like, please don't say that.
100 basis points, and then
how much have you made on it so far? Do you like it 100, or did you catch more off of the original contract?
Measures that would lead you to slow.
I'm really impressed with this trade you did. Oh my God, really? Oh, you had 5 on? Oh, my boy. I am so proud of you.
So
Wow. I'm so proud of you, man. Good job.
looking at all of those things,
Good job.
market inflation, and we're going to be
And then coming right back up to that high where I started at, where my average position is from. Should I start averaging in again? Watch it come back? Yeah.
at some point it will be appropriate.
Well, anytime I get the trade that you've got right now, man, it comes back on me. Yeah.
Front end loaded these very large rate increases. Now we're getting closer to where we need to be. So that's how we're thinking about it. And we're, in terms of September, we're going to watch the.
I must say, because again, he has to be really careful about what he says, and he's been writing the line really well.
About what that might be. But I mentioned that we might do another unusually large rate increase, but that's not a decision that we've made at all. So we are, we're going to be guided by the data. And I think you can still think of the destination as broadly in line with the September.
Holding for 40 points?
Because it's only 6 weeks old, and sometimes SEPs can get old really quick. I think in this one I would say is probably
well, you did 89, so you need to get to 40, 30, so you're close.
At the end of the year and then into next year. So I would point you to that.
Hi, thank you. Chris Rugaber at Associated Press. I wanted to ask about, right now there is a sort of growing gap between the Fed's preferred measure of inflation, the PCE index, and the one that's followed by the public, the CPI, of course. How do you expect to handle this divergence?
Right, you're basing it off of the volatility from the previous meetings.
To consider slowing rate hikes, even if the public is still seeing much higher CPI ratings. Thank you.
So it's an interesting situation. Of course, we've long used PCE because we think it's just better at capturing the inflation that people actually face in their lives. And I think that view is pretty widely understood. That said, the public really reads about CPI. And the difference really is because the CPI has higher weights on things like food, gasoline, motor vehicles, and housing than the PCE index does. And so that accounts for a lot of the difference. However, over time, they tend to come together. We were given the importance in the public eye of CPI.
This stays the high of the day. I guess I was wrong.
And everything like that. But remember, we do.
Well, the thing that I'm thinking about now is like what kind of flows were being held back and are going to come through now. Ooh, we got Chick-fil-A.
Very long time. And if it
No, go back. Go.
40
Out.
basis points, that would be very noticeable. Now it's
Go with mom. Thank you.
larger than that because of the things I mentioned.
So I've kind of been feeling that there was a lot of people that would be selling on earnings and so on and so forth, that, that flows could start to come in after the Federal Reserve meeting and everything. But seeing the S&P 500 jump up so strongly
a couple of things
kind of gives me pause on that. Well, they are turning a little bit there.
You said that the destination pretty much remains the same.
The volatility here is so high, dude.
But where
I don't know, man.
The journey.
I don't know.
Now seeing the federal stimulus programs end, you mentioned consumer spending, business investment have slowed.
This is why I don't have a live trade on right now.
You would expect, or is demand still greater than supply, too much greater than supply, that you need to do significantly more? And I ask because there are lags in the impact of monetary policy, as you mentioned, and a lot of this might hit in 2023. The strong dollar effect may hit in 2023 when the economy might be weak. How do you know where you are and where you think?
Look at that long volume coming in. I don't like that at all.
Demand for a second. As I mentioned in my remarks, I think you pretty clearly do see
volume in the 10-year
demand in the second quarter. Consumer spending, business fixed investment.
So again, I get this thing where it's like they ask the question, and of course, I know that on YouTube we're probably delayed by a few seconds. But as they're asking the question, you start to see people speculate on it,
Direction of the economy.
and then he answers the question, and they don't actually get anything from
At
it.
the same time, you have this labor market. So there are plenty of experiences where GDP has been reported as weak, and the labor market is strong, and the economy has gone right through that and been fine. So that's happened many times, and it used to happen, if you remember, in the first quarter of every year for several years in a row, GDP was negative, and the labor market was moving along just fine, and it turned out to just be measurement error. It was called residual seasonality. we don't know the situation. The truth is, though, we think that demand is moderating. We do. How much is it moderating? We're not sure. We're going to have to watch the data carefully. There is a great deal of money on people's balance sheets that they can spend. The unemployment rate is very low. The labor market's very hot. There are many, many job openings. Wages are high. So it's the kind of thing where you think that the economy should actually be doing pretty well in the second half of the year. But we'll have to see. We don't know that because you do see a marked slowing in the second quarter that is fairly broad. So we'll be watching that. We'll be watching that. Of course, as I mentioned, we do want to see demand running below potential for a sustained period to create slack and give inflation a chance to come down.
Nicole. Hi, thank you, Chairman. Nicole Goodkind, CNN Business. When does the committee expect to see a meaningful slowdown in the labor market, and how much weakness will it accept with regard to slower job growth and higher unemployment before it pauses or begins to think about cutting rates?
So I think you're already seeing, you've seen in the labor market, what you've seen is a decline from very high levels of job creation last year and earlier this year to modestly slower job creation. Still quite robust, as I mentioned. So you're seeing that. You're seeing some increase in initial claims for uninsurance, although that may actually have to do with seasonal adjustments. We're not sure that that's actually real. There's some evidence that wages, if you look at average hourly earnings, they appear to be moderating. Not so yet from the other wage measures, and we'll be getting the Employment Compensation Index measurement, I think, on Friday, I guess. And that's a very important one because it adjusts for composition. So I'd say and also anecdotally, you hear much, the sort of level of concern on the part of businesses that they simply can't find workers is probably down a little bit from what it was, say, for example, late in the latter parts of last year. So there's a feeling that the labor market is moving back into balance. If you look at job openings or quits, you see them moving sideways or perhaps a little bit down. But it's only the beginning of an adjustment. But I think most, also if you look at, once you start citing these things, you can't stop. If you look at the household survey, you see much lower job creation, and the household survey can be quite volatile, but it has no jobs created in the last 3 months. So that might be a signal that job creation is actually a little bit slower than we're seeing in the establishment survey. So, executive summary, I would say there is some evidence that labor demand may be slowing a bit. Labor supply, not so much. We have been disappointed that labor force participation really hasn't moved up since January. That may be related to yet another big wave of COVID, and there's evidence that that's the case. But so we're not seeing much in the way of labor supply. Nonetheless, I would say some progress on demand and supply getting back in alignment.
How much weakness would you be willing to accept before you think about pausing rate cuts?
So I think we're going to be looking at inflation as well. We as I mentioned, we need to see inflation coming down. We need to be confident that inflation is going to get back down to mandate consistent levels. That's not something we can avoid doing. That really needs to happen. But we do think, though, that the labor market can adjust because of the huge overhang of job openings, of excess demand, really. There should be able to be an adjustment that would have lower than perhaps...
I don't know, man. Like, it kind of stopped there at 40-20.
Lower than would be expected.
Maybe he's the reason that it stopped there. But now they're busting back through.
Of vacancies to unemployed is just out of keeping with historical experience, and that suggests that this time could be different.
I'm feeling this is what it must be like to watch my stream, right? Because I'm just watching Kevin's along here, and I'm feeling greedy for him, you know.
So how
get up there, get to 40-30, so close.
Possible recessions from banks and economists. How does that make a soft landing you've talked about more difficult?
So as I mentioned. It doesn't seem that the U.S. economy is in recession right now, and I think you do see weakening, some slowdown, let's put it that way, in growth, and you see it across some of the categories that I mentioned, but there's also just the very strong data coming out of the labor market still. So overall, you would say that in all probability, demand is still strong, and the economy is still on track to continue to grow this year. But the slowdown in the second quarter is notable, and we're going to be watching that carefully. Sorry, what was a lot?
Forecasts. How do bank forecasts of possible recessions, economies, does that affect the soft landing?
Well, we've said since the beginning, I think, that having a soft landing is what we're aiming for. Of course, that has to be our goal. It is our goal, and we'll keep trying to achieve it. I do think events. At the beginning, we said it was not going to be easy. It was going to be quite challenging to do that. It's unusual. It's an unusual event. It's not a typical event, given where we are. If there is a
Let's try and take a bigger look here at the S&P 500. That's the highest it's been for quite some time, right? Breaking out of 4020, there could be some serious volume coming in chasing it here now.
That demand.
I think I need to go to a daily chart.
Translate into a big increase in unemployment, as you would expect in the ordinary course, because frankly the imbalance is so much greater. But we don't know that. I mean, this is a case of first impression. So anyone who is really sure that it's impossible or really sure that it will happen is probably underestimating the level of uncertainty. And so I would certainly say it's an uncertain thing. Nonetheless, it's our goal to achieve it, and we'll keep trying to do that.
Thank you,
Okay.
Mr. Chairman. Jean.
So you don't get into like previously significant levels really until 4050. So probably because of options and stuff, I'd expect 4050 could be good.
The Fed did it.
So
What are you learning about how it's working?
now let's try and look at it from a volatility projections perspective, okay?
Level of reserves needed in the system still several years away at the current pace.
So we think it's working fine. As you know, we tapered up into it, and in September we'll go to a full strength, and the markets seem to have accepted it. By all assessments, the markets should be able to absorb this, and we expect that'll be the case. So I would say the plan is broadly on track. It's a little bit slow to get going because some of these trades don't settle until for a bit of time, but it'll be picking up steam.
Okay, so for what the VIX was pricing in at the beginning of today, the breach of 4020 was beyond what the options thought that they would be. So you're kind of already into a significant outlier based on
between 2.5 years.
Expected volatility.
And, this is a much faster pace than the last time. Balance sheet's much.
I'm actually surprised that we are.
But we looked at this carefully, and we thought that this was a sensible pace, and we have no reason to think it's not.
Hi, Chairman Powell. Brian Chung, Yahoo Finance. Looking at financial conditions, it seems like the tightening has slowed as of late with the 10-year coming down, 30-year fixed mortgage rates also going a bit sideways when we talk about a hot housing market still. Just wondering if you find financial conditions tight enough, especially as you continue to raise rates.
So a big piece of that is inflation expectations, break-evens coming down, which, is a good thing. It's a good thing that markets do seem to have confidence in the committee's commitment to getting inflation back down to 2%. So we like to see market-based, readings of inflation expectations come down. Broader financial conditions have tightened.
That's an interesting comment that he thought to mention that first, because I've been sitting here being like, how can it be 3? But he's saying, well, it's coming down because real interest rates are coming down.
We're just going to do what we think needs to be done. We're going to get our policy rate to a level where we're confident that inflation will be moving back down to 2%. Confident. So that's how we're going to take it. And of course, we'll be watching financial conditions to see that they are appropriately tight and that they're having the effect that we would hope they're having, which is to see
treasuries are starting to look a little,
and ultimately inflation come down.
The 30-year in particular is acting different, and they are getting some spreading.
Market Watch. I wonder if you can go back a little bit in time to before there was this outbreak of inflation, when the committee put in place forward guidance on tapering asset purchases. I think it was December 2020. There's a recent speech by Fed Governor Waller talking about that and saying that maybe that was too tight, that kind of condition, and it put you a little bit behind. Not his words, but maybe, you know.
I would be wary about trying to make too much of a read off of what happened on the last FOMC meetings outside of the amount of volatility that we should expect, right?
Mandate goals. And the reason we did it in real time was that the first look at the new framework.
Volatility clusters. So you can do that kind of analysis with volatility.
People were saying, oh, it's not credible, you'll never get inflation to 2%. Some of our critics now who say inflation is too high were the same ones who were saying you'll never get to 2%. Well,
yeah.
But anyway.
He's so right.
So
I agree with him.
We needed to really make a strong.
All these people that are like, you know.
December 20 guidance was not part of our overall.
No matter what the Fed does, they say the Fed is wrong.
So
they contradict themselves. Yeah.
Two things. One, I don't think that is a material.
What is the 2-year at, by the way?
But I have to admit, I don't think
almost 3. Huh?
I don't think I would do that again. We, you know, ultimately the situation evolved in a highly unexpected way for all of us, and you know, maybe the learning is that leave a little more flexibility than that. But did it matter in the end? You know, if you look at, I really don't think it did. I'm not sure it would have mattered if we'd been raising rates 3 months earlier. Does anybody think that would have made a big difference? I mean, a lot of central banks were raising rates 3 months earlier, and it didn't matter. I mean, this is
well, yeah, but they're not the United States government.
Decidedly different in the United States.
I would disagree with you, pal.
Anyway.
I understand where he's coming from, but I do think that 3 months could have made a big difference.
People talk about that
because they would have already been ahead of the curve at key points. It would have affected the trajectory of the markets. I think so.
That you had experienced as a governor. So was that part of that? Where did that fit into all this? Thank you.
So I think we learned.
He's using a lot of indecision type words. Yeah.
Right. So there was the famous one in 2013. There's what happened at the December 18 meeting where, you know, where markets can ignore developments around the balance sheet for years on end and then suddenly react very sharply. So we just had developed a practice of moving predictably and doing it in steps and things like that. It was just like that's how we did it. And so we did it that way this time. We were careful to take steps and communicate and all that kind of thing. We were trying to avoid a tantrum.
It's not like him from previous. Well, he's getting better at it. I mean, he's always basically tried to practice that, you know, give them as much useful information as possible, but don't actually tell them anything that would affect the markets, right? So he's been playing the line really well today, though. He's gotten good at it, right? This is having watched him over the, what has it been, 4 years now, the past 4 years?
Our view was
oh, man. We've seen him at dozens of press conferences now, right? He's gotten better at it.
Come back. Everyone would get vaccinated.
I dare say he's good at it now.
School and labor force participation would jump back. You know, that was very broadly thought to be the case. You know, these supply side issues would get solved reasonably quickly.
Watch the market dump tomorrow as usual, says the genie.
So that's really the learning, I think, is around.
I don't know. The thing is that the market has been on a buying spree here for a while.
And so that's really.
And it's been kind of like this share buyback fueled rally that everybody hates.
In October,
I think that maybe the movement in the ES here this morning kind of says that there were some people that did want to see it go down and gave up on that trade.
You started to see a range of that said, no, this is a much stronger economy.
But I don't really know what the flows tomorrow and Friday are really truly going to be.
We are.
But if it comes out tomorrow and it's higher tomorrow and they buy on the open, I'm not going to fight that trend, right?
So if we get a negative GDP number tomorrow for the second quarter.
Yeah, the last times the market dumped and the next day it started with Asia. Yeah, that's a good point, Kevin.
What is your definition?
Those other moves, like there's been a lot of key moves around the FOMC when you look at the chart, but they weren't necessarily caused by the FOMC.
there is now a recession and that kind of thing. So that wouldn't be something we do. We would look at the data tomorrow, and no doubt we'll look at it very carefully and draw whatever implications we can. As I mentioned.
So here's the risk that I see here.
If you think about what
is he's working very overtime to not say anything market moving here, but the other Fed speakers won't.
Months, and there are a bunch of specific tips.
Right. Let's come in here. Let's look at our schedule. Do we have any Fed speakers in the next week?
Seem like that, and the real reason is that
or rather, we should. So what are they?
A signal of economic strength that it makes you really question the GDP data. But again, that's not a decision that we make, and we won't reach a conclusion one way or another on that.
Yeah, Yellen is speaking tomorrow. Tentative.
Thank you very much. With The Economist.
Okay.
You said that some softening in the labor market is needed. Within the Fed, there
I don't actually have anything.
That NAIRU, the non-inflationary rate of unemployment, might be as high as 5 to 6% right now, which obviously is a lot higher than the current rate of 3.6. What's your assessment of NAIRU? Is that something that came up in discussion with the committee?
That's interesting.
Broadly, a lot of economists think that the natural rate of unemployment will have moved up to some significant extent above where we think it was before. And the reason is it's the usual matching issue where matching has become less effective and that kind of thing when you have the kind of turbulent downturn and the big switches in demand from services to goods and all that. So it could be higher, and my own instinct is that the natural rate of unemployment is higher. Of course, I would add that we don't know it. We can never know where these star variables are in real time with any confidence, but I would say it must have moved up materially. But the other side of that is as all these jobs get created and people go back to work and unemployment is so low, I think you could, in principle, you could see.
I'll just say you started the money printing machine. No.
And that would also, by the way, take pressure off of inflation because it's that gap. It's the gap between actual unemployment and the natural rate that.
I mean, this just brings us into this crazy cycle again. Like if the market off of this FOMC meeting starts on a more extended bull run, well into the like the 4200s and above.
We don't control that, but
then all of a sudden you got to be really worried about inflation again, right? And then we just go through the whole circle again.
The labor market caused the natural rate to move up. Then as the labor market settles down, in principle, you should see it move back down.
Thank you, Chair Powell. Jeff Cox from CNBC.com. Just a question about, hate to keep banging the drum about recession, but most of the that we're seeing now from the public believe that we're already in a recession or heading for one. Economists pretty much the same thing. They're being told by folks like you and in the administration that we're not in a recession or we're not heading for a recession. Frankly, coming from the same people who told them that inflation was transitory, telling them now that we're not heading for a recession.
Well, Jeff Cox is not holding any punches.
You feel confident in your forecast going forward, and the Fed is ready to respond to a potential downturn in the economy.
Man, that was the most gutsy question in Federal Reserve history.
The case. It's because you do see a very strong labor market, and I think the public will see that as well.
Oh, okay. So he's got the answer. That was the most gutsy asking of a question I think we've ever seen in the FOMC press conference.
A slight.
I've seen every FOMC press conference we've ever had, right? Because this was something that started after the pandemic. I've seen every one.
I mentioned that
I can't believe he asked the question in that way. That was bold.
To bring inflation down and have a so-called soft landing, by which I mean a landing that doesn't require a significant increase, a really significant increase in unemployment.
Okay, so let's try and poke a hole in this argument for the sake of argument's sake.
Many occasions that we understand that's going to be quite challenging and that it's gotten more challenging over recent months.
Thanks, Chair Powell.
Nobody wants to follow that one up. Okay.
The FOMC has historically tried to avoid the kind of rapid monetary policy tightening that has happened so far this year. how concerned are you that the rate hike
Okay, so what was July?
might increase risks to financial stability?
Non-farms employment change.
I mean, there are precedents for the FOMC moving very quickly. For example,
It's coming down. It's still a very high amount of jobs growth.
appropriate thing to do, and this year it clearly is.
We go back to before the pandemic.
Given how quickly
Okay, can we? Let's see here.
gratified
Let's
that
go through all of this and like.
that basically markets
Have
have
it like
been
that.
working. They've been orderly. There's been some
Not
volatility,
that.
but
Not
that's only to be
2008.
expected. For a financial stability perspective,
Okay, so like normally it would be 200 to 300, right?
down,
And now,
in some
now we're getting 300 every month.
It's
So that's why he's saying that.
you would worry that they're vulnerable to a fall. Actually,
The trend is down, but the amount that you're getting per month is still quite high.
banking system. I think you have households are generally in about as strong financial shape as
It's almost there.
in a very long time, or perhaps ever, given what the money that's on people's balance sheets, and so you have a pretty, from a financial stability standpoint, you have a pretty decent picture. Now, the macroeconomic, there are plenty of macroeconomic issues that don't rise to the level of
Now, what about unemployment claims,
financial
right?
stability. You know, we think of that as things that might undermine the working of the financial system. So big, serious
Well,
things.
unemployment claims have been going up.
People at the lower end of the income spectrum aren't suffering, because they are. They're suffering from high inflation.
So is employment really that good, or maybe you're seeing the same data errors there? Why is it that we point out there were issues with the data when it was kind of against what we thought or what ended up happening, but we're not questioning the data with employment right now?
Very unfortunate, and
I think that's probably the best argument that we could make for
one of the reasons.
That the labor market does not reflect the probability of us going into a recession.
Camrick with Bankrate. I can remember when you held your first news conference, you were proud to be a very plain-spoken chairman, and we're thinking today about the impacts of Fed policy on individuals as well. What would you say to individuals or households who may yet lose their jobs in this tightening cycle in the fight against inflation as they try to translate what Fed policy means to them in this complicated economic landscape? Thank you.
So I guess the first thing I would say to every household is that we know that inflation is too high. We understand how painful it is, particularly for people who are living paycheck to paycheck and spend most of that paycheck on necessities such as food and gas and heating their homes and clothing and things like that. We do understand that those people suffer the most.
Almost
Middle
there.
class
Almost.
and better off people have some resources where they can absorb these things, but many people don't have those resources. So, it is our job, it is our institutional role. We are assigned uniquely and unconditionally the obligation of providing price stability to the American people, and we're going to use our tools to do that. As I mentioned, there will be in all likelihood, some softening in labor market conditions. We need growth.
Touched it. Probably wouldn't have gotten filled, but you touched it.
We don't want to
43.30. Oh, there it is. Oh, Schnaya.
It needs to be, but ultimately, if you think
Did you get your fill that time? Oh man,
price stability is the thing that makes the whole economy work. It's what
it was like lightning. It was like somebody just bought everything there and went.
eaten up by high inflation. If you talk to people, again, people who are making wages, relatively low wages,
Okay.
they're the ones who are suffering the most from inflation.
Somebody was buying. It kind of looks to me.
Thank you very much.
It looks to me like a robot buy-in here. Oh, okay. So the reason why I saw that spike was because somebody had it set to as soon as the press conference ended to buy. That's what that was all about. So, entonces, how much further can they go in the next 30 minutes? Yeah, I think, while I've seen it go both ways, but typically you'll see extensions into the close, Now we got to start thinking about what the market on close imbalance is going to be. right? Because the thing is we're well beyond, well, not well beyond, but we are beyond any ruler that we could use to judge things based off of past history, right? At this point, it all comes down to how many more buy orders are there going to be between now and the close. I messed around on Sim a little bit, and I actually made money twice. 3 times. Quite good, actually. All things considered, I did have some adverse excursion, but my favorable excursion was more than double what my adverse excursion on both of those trades were. And it wasn't too bad. I was doing reckless things, so you know. I wouldn't take those trades too seriously. But in terms of just messing around, yeah, feels pretty good. Feels pretty okay. Maybe I might feel a little bit more confident tomorrow if I see opportunities to try and take a live trade. We're just keeping an eye on ES now. Man. I mean, they just blasted right through 40-30, right? Ew, my voice. They really blasted through 40-30, so. But like, look, the amount of volume, like the prints that you're getting on the inside are still quite robust. That's what that was. Okay. Should we stick around until the close? I think we got to stick around at least until Kevin catches a winner. Is this your largest winner you've ever caught? I think that's well beyond my largest winner. Well, actually, point wise, there was this one time that I caught like 100 or 200 ES points once. It was like when there was like an attack on an oil place or something. It was like, oh, you did the 2K in oil. Oil is freaking, yeah, okay. No, what was it? It was like when they attacked that Saudi Arabian refinery. You remember that? And the S&P 500 just like totally took a dive and then recovered or whatever. And I had that and I was long. Oh, did you take it off? Take it off now? Oh, sorry, I didn't see it. Out 35. Yeah, 40. 40's good. Yeah. Well, the thing that's going to be interesting here is, would you have been able to hold it to the close? That's the one that I'm always interested in. Is like the trade where you hold it all day and you take it off into the close and it's good. That's what I was always trying to do in ES. And I always had such a hard time doing it for whatever reason. Just seemed like it should be a simple thing and that you should be able to get it like at least 30% of the time. But no, it's like it only ever happened to me once or twice where I took a long trade that I was confident enough in that I could hold it the whole day. Treasury is a different story. Treasury, sometimes I'm just like, yep. We just keep this as long as we can. Now, coming back to the treasury, actually, let me change my workspace back around here. I need to close inventory for, I don't know what I need to do. I think I do know what I need to do. Oh, yes, I do want to save that. The thing is I think there's something on NinjaTrader that I've got running that can kind of slow down in fast action, but I think that it's this one indicator. I think it's this thing that I've got in my watch list. There was a well, anything is better than intraday trading, Belgian. Making money from intraday trading is really hard. But yes, buying at the close and selling at the open has unusually yielded the most profits, the majority of the profits in the S&P 500 over the last 10 years. I think that kind of suggests, and I think that the leading theory on this is that it's China that is driving that buying. With 1,000 positive Delta bar? Yeah, I gotcha. And then it ended up being a Haramari bar or whatever. Mm-hmm. Oh, I'm surprised how quickly people left after we had the Federal Reserve meeting there, after the press conference ended. That's interesting. Okay. Now we got that going. Okay. So come here and look at the treasuries here, right? So again, we got 30, 10, and 5. Okay. The 5-year moved up quite clearly and just kind of balanced around where it was. The 10-year has retraced a lot of it and come back to where they were before the news. And the 30-year is significantly lower. So we are having a steepener, and you can see it right here in the spreads, right? They're all tilted to the upside. That means steepener. Okay. Dollar weaker seems to be sending cryptocurrencies and gold and silver and everything higher. So maybe gold catches a break today. There you can see there's the Bitcoin. Make it big for you. Pretty aggressive move up there on Bitcoin, although it is just recovering moves from the previous 2 days. So now when we come back again, S&P 500, I think we should watch it on this chart right here. Oh, did I not fix this one? I have a new one. Did I show you my new indicator? I'm quite proud of it. Let me show you my new indicator. Called multi-ATR. Right? So it shows me what the average true range was, and it shows me the daily ranges. And then if I go back into the indicator here, I will be putting this out to the Speculator Seth Indicator Suite lifetime subscription people here when I'm ready to put it out. There's a couple of other things that I'm changing right now too. We'll put them all out at the same time. Anyways, so you can change the type. It can be points, ticks, or percent. So I think for the S&P 500, it's better to use percent. So on a relative basis, the actual degree of the move that we've had so far today is actually quite mild. So that's a little surprising, and it's surprising that the VIX has been, expecting it so low. But it is what it is. So 40,000. Remember that we messed around with 40,000 for a long time. But once we get to 4,100, that's where, tactically speaking, just from the psychology of people, that might be a spot where anybody that thinks that we're really in a recession, they're going to really double down. And if they can get above that, then everybody's like, oh, it's over. Everything's fine. We can buy all the things. Right? So that's really what we're looking at there. The 10-year continues to sell. If I had held on to both of those trades, both of them would be like big time in the money right now. Wow, somebody hit that at 120 super aggressively. Maybe I should have taken the trade because I'm still preferring long rates here. I still prefer long rates, and I like long 10. I think well, hell, why am I not in this trade? I think you go long 10, short 5. right here in the micros. Why don't I want to do that? Why does that make me nervous? Like, look at them push. I guess there's not really, with 30 minutes left, I don't know if there's much point in trying to take that trade because it could very easily come back to our entry points and everything. But we're seeing some steepening, man. Some significant steepening today off of this, which is very different from what the treasuries have been doing. I think that the steepener, after all of this, the yields steepening out is probably the most significant thing that I'm seeing. Again, press conference didn't really tell us much, but S&P 500 did buy pretty hard. Right. By the time employment is slackening to the degree the Fed wants, we will be in 2008 all over again. I don't know if I agree with that. Like, again, the employment numbers that we're seeing per month are about what they were before the pandemic. Doesn't really give us a whole lot of ammunition to say they're going to pivot or not, right? Well, I think since Kevin got his winner, it's at least in your top 10 winners. That's a good job. It'll be more like 5 ES cut Matt. That'd be amazing. That'd be amazing. I think I will get going. Because I mean, it's gonna move. It's gonna do some interesting stuff, but I don't really have a whole lot to say about it right now. I want to think a little bit about what has transpired this day and what we might see tomorrow. Them treasuries are kind of selling hard though. They are kind of selling hard though. So, Hmm. Man, LinkedIn wants me to look at Robert Reich. Nobody cares about him. Okay. I'm going to leave. Guys, tomorrow. This was fun. Interesting day. See you tomorrow. In the meantime, stay profitable, friends.